Gopika Joseph encountered in her personal journey that knowledge transferred is rewarding. So thank you for joining us. Feel free to start whenever you're ready.
Thank you for having me. All right, so we're going to talk about budget and TFSA today. So the agenda today is to basically start off with budgeting. What is a budget? Let's look at the short and long-term goals that you can actually plan using a budget, and then how to create a budget. And then the second item that I have here is for you to introduce what is a TFSA and the pros and cons of it. And then, of course, how to understand the contribution chart to understand how much you can contribute. And then that'll be all for today. And then we can open it up for question and answers. So let me start off basically with the definition of budgeting. So budgeting is basically a simple process where you actually would plan to keep track of how much money you're spending, basically. And so every time you're spending money or money is leaving out of your pocket, you need to jot it down or keep track of it. And so you have an idea of how much money you're spending, where your money is going, and do you have enough money to actually spend on the things that you want to spend. So a budgeting actually creates a little chart or a little agenda and a process to keep track of your expenses, let's say. And then if you have enough money, for example, to do everything you would like to do, then you are obviously using this budget to plan effectively and prioritizing basically where I should spend and where I can spend. And so here is a simple example of income and expenses. I'm hoping you can see that. And so here income is basically where you're saying money is basically coming in, and expenses is when money is leaving out of your pocket. So here you as a student have various reasons and several reasons today to know what a budgeting is. Basically, here it says 39.6 million or billion dollars have been spent on food for college students and university students. And then here we're looking at a 70% of money is gone to actually on living cost. And so it's rental and actually maintaining your cost of living in here. And then for some of you, you may have had your parents help you contribute to your tuition. So here's, it says 20% of the parents have helped, and some of you are probably have borrowed money from loan from the government. And so you might be facing a lot of student debt. So when you graduate, you're looking at, yay, I got my degree, but at the same time on your back, you're saying, I have all this load that I need to now learn how to pay it off. So here you have a very good reason to start a short and a long-term plan. So here you're basically starting with a goal, and you're actually cutting it within 1 year. We can call it a short-term goal. And then anywhere from 1 to 5 years could be a medium goal. And then anywhere from 5 to 10 years, you can actually say it's a long-term goal. So in your planning, you can basically jot down what you would like to achieve. You're going to be very realistic. You're going to be honest. And then you're going to jot down what you would like to actually get done, basically. And so you would write down everything from year 1 to 10 or 5, depending on your planning. You would actually lay out the goals in there. So a few things that I have listed here is obviously when you graduate, you want to start looking for a job, or if you have your own business plan, you want to start up your own business. And so you would actually work towards that gradually from year 1 to a deadline when you want to achieve that. And then another question you might ask is, after graduating, would I want to go back and live with my parents and reduce my rental costs? So you're actually reducing your expenses, amount that you want to spend, if you have the feasibility to go back and live with your parents, or actually move into a place where it's much less in rent expense. And then you're thinking about your eating and other expenses. So dine in, eat in, buy groceries, and less dining out. Do I need to buy clothes versus I want this outfit. So you can think about eliminating buying too many clothes and then maybe living with what I need versus want. So you're looking ways to actually reduce or cut costs, and then maybe put a little small goals like going out and spending and enjoy life also to some extent. So here you're looking also, one of the biggest goal would be to pay off your student loan. You can start with portions, a little bit of it every month, goes a long way. And then you're also finally deciding to save money or put money aside. And that's what we're going to actually learn. So when you're looking at this schedule, it helps you to actually plan what I want to achieve in short term, which is 1 year, versus long term. And so here is a simple budget. If you have some time, I have a video, or you can actually jot this website and then go in there and take a look at it. So you can see here, there's a hand with a dollar sign. So that's any amount that you actually receive is actually money coming in. So here, if I zoom here, you can see the projected monthly income. So basically you're looking at any anticipated income or any potential money that I'm going to receive. It could be just pure earned income from a job, or any money that your parents would give to you as a gift, or any grants, or anything that money flows into your pocket, you would call it income. And so you would have a projected or anticipated income versus when it actually happens throughout that month, you will actually jot it down as actual money earned or actual money received. And so here you can see there is slightly difference. It's an example here. So they're actually anticipating to receive extra $300 income. So that $300 income is actually an extra income that they did not actually, or they would not get on a regular basis. And so you're actually recording the actual receipt of your income, and then you're comparing it. And then you're also jotting down all your expenses. Now, your expenses doesn't have to look exactly like this. You can actually go onto a Excel spreadsheet and just create columns and break down your expenses reflecting your goal. So if you decide to actually dine in, then you would actually probably have grocery bills. So grocery expense could be one column. And if you're actually renting, you would actually have rental expense and so forth. So every hour when you go out for movies, entertainment expense, eating out and so forth. So for every activities that you actually plan to do on a regular basis, you can actually break them down. And so the more detail you have, you actually get to see how much money and where your money is being spent. So here is a typical example of you're looking at housing cost. So here is when you're actually owning or renting some of the expenses you may have to pay. So you're actually having a projected goal cost and then actual cost in here. So you're comparing that and then actually looking at your differences here. The other one is transportation. That's one of the biggest costs for some of you, where you're traveling or you have your own vehicle, gas, insurance expense and so forth. And the other one is entertainment, movies, eating out and so forth. And then the other one is your student loan. So how often are you paying your student loan? How much should I actually put down? Or sometimes you're given a certain amount to pay back. And so you would actually record that amount as well. So all this tallied up in total would be your total expenses. So if you take your income, actual income minus actual expenses, would give you either a positive or negative number. So a positive number tells you that you're living within your means. So let's say you're making $5,000 and your expenses are $4,000. So you have $1,000 extra. So which is what we want to focus on. The second part of this discussion is to save that money and utilize that money for the future. So that is actually a good thing. Now, if your income is $5,000 and your expenses is $5,200, then you're living beyond your income level or beyond your means. And so you need to actually learn to actually cut down your cost and live within that budget. So that's why we create a budget to understand our income, our money coming in and money going out. So if you're in a negative zone like this here, that means it's not a good news. That means you are not living within your income. So we want to focus on where you have a positive number and utilizing that number towards your future. So here we're going to go on to the next topic here. When you have that extra cushion money, well, that's when we say we want to save or put money aside for rainy day, for unexpected events. We want to utilize that money and whenever we need to. And then in order to actually utilize the money, we want to actually keep that money and let that money grow into a larger amount. So not keeping it under the mattress or keeping it in a jar or bottle or whatever it may be. Some people have these ways of keeping it. It's not going to grow. So it is actually better to invest in something called TFSA. So TFSA stands for tax-free savings account. And so the tax-free savings account was basically introduced in 2009 to all Canadians to save more. So here, any amount that you put aside will be invested into a place, and that would actually help to grow. So you can actually go into a banking institution and say, I would like to open up a tax-free savings account and invest some money. So you can plan to put aside every month $500, depending on how much you have extra money to save, or $100. You can start with small amount and then put that money aside, and that money is going to grow over a number of years, and then it's going to help you to pay off anything, buy a large ticketed item like a house, car, and so forth. And the good part is that it's tax-free. So if you take that money and put it into savings, and when that money grows, let's say $10,000 grows into $15,000, that $5,000 increase would not be taxed. And that's why it's called tax-free. So when you want to withdraw that money, it's also tax-free. So they will not tax you, unlike the RRSP, which you may have heard. So here, there are some rules that you need to abide by in order to invest into TFSA. So you need to be a Canadian citizen. You have to have a SIN number. You want to be over 18 years of age. So that's the eligibility criteria. And so if you have all of that and if you had filed your tax return, you can actually open up a TFSA account. And so the third component on TFSA is it has a contribution limit. So every year, the government sets a certain dollar value, how much all of us can contribute towards that savings account. So doesn't have to be, basically it doesn't have any criteria. I can make more money or less money. It's not dependent on any factors. It's just a standard rules that's been released by the government. And so that amount is released to the public. And so we can actually contribute to that maximum amount. So in 2021, which is this year, the government released that you can put in actually $6,000 up to, you can contribute. So this contribution started in 2009. So if you have never opened one up, you have $75,500 to contribute from 2009 to today if you were 18 years of age in 2009. So you have to be 18, and only then you're eligible to take advantage of it. So if you turn like 18 in another year, then from that year onwards, you can actually put in and maximize your contribution limit. So I'm just going to show you a chart. So if you look at this chart here, let me just zoom it up here. So 2009 to 12, the government said you can input $5,000. So whenever you turn 18 from that year, you can take your calculator and add. So let's say if you turned 18, let's say in 2012, from that year onwards to 2021, you would add up all these numbers, and that will be your maximum contribution limit. So it all depends on when you turned 18. So if you turn 18 prior to 2009, then you are eligible for the maximum $75,500, which is all of it on this chart. So if you look at it, some years they've changed the amount, 5.5K, and then in 2015, they maximized the amount to 10K. And then thereafter, for another next 2-3 years, they reduce it to 5.5 and it's back to 6K again. So this is your contribution chart limit. So you would actually look at that and then just go in and calculate how much I can contribute. Now there are pros and cons in TFSA. So there's more advantages than disadvantages. So the benefits outweighs all your disadvantages basically. So you can contribute any amount within the limit that is feasible to you. So you don't have to take advantage of all of the maximum amount of your contribution. You can actually contribute how much you have money that you can save every month and then put that aside. So there's no restriction on withdrawal. You can also withdraw the money anytime and any amount basically within the contributed amount. And so all earnings, as I said, in my example from 10,000 to 15,000, the 5,000 that it increased in value, it's not taxed. So anytime you invest in any type of investment, it could be a dividend or stock market, any of the investment, you would actually incur interest income or capital gains and so forth. That's not taxed. So no tax deduction on withdrawal, no tax deduction on growth of your money. And you can contribute amount withdrawn at the beginning of the following year. So let's say, for example, last year I did not contribute. So that's 6,000 is my maximum amount that I can put in for 2020. So I did not utilize that amount or at all. So I can actually wait till 2021 January, and then I can actually contribute last year's amount plus this year's amount. So I have $12,000 room to actually invest into this TFSA. So that's the advantage of it. So you don't lose your contribution room, sort of. So you can actually utilize that in the future, but you have to wait till the following year on January. So share contribution room with spouse. You can also share with your spouses and you can help each other to contribute. But I said but because that's a negative thing, because once you transfer those things, you can also say that that person is legally responsible for their TFSA. So it won't be your money, but you can utilize it together for any purposes. And then if one of your spouses passes away, it's usually transferable upon death. So you can actually assign a beneficiary and so forth. So it's actually very good. So it has many advantages, but the limitation is that you cannot over contribute. If you do over contribute, you will be penalized at 1% on each month or on a monthly basis for the over contribution amount. So you want to make sure that you do not over contribute. So if you want to make sure, how do I know to be sure how much money I should contribute, go and log into your MyCRA account, and then you can actually get that information. And so every year it's calculated based on your age. They would actually tell you, you have this much room or maximum contribution amount to invest. Now, parents do also contribute to help their children on TFSA, not only through RESPs, but also through TFSA. So when they do, there is no legal rights to that investment for the parents. So that's the disadvantage here. But then the children get to utilize their money and use that money towards any big ticketed item or even help them for the schooling and so forth. So that is the topic on TFSA. So I would say TFSA is beneficial for people who are in a lower income bracket. So when you're starting off your life, you're actually on a lower income bracket. So you should be actually utilizing the TFSA. But if you are in a higher income bracket, then you might want to consider still putting money in TFSA, but maybe taking advantage of RRSP. So that's something totally different. That's for higher income earners. So, so that's pretty much it today. But I do want to take you, since we have a little bit of time, I want to take you just to show you how this money can grow when you save. So I'm just going to come out of it and just post this link here and then just show you. I just want to put some criteria that I want to see how money just actually magically grows into number of years. Let's say you want to put in just $100 here, and then let's say you want to put in every month. So let's change it to monthly. And so you can project it for 10 years. For the next 10 years, you want to contribute, or 20 years. So let's put in for 25 years. And then usually the money is going to grow on a standard 7%. So usually a mutual fund investment would grow anywhere from 7%. So if you put it into a bank usually gives you anywhere from 2 to 3%. So GICs and so forth, it's a lower savings account. But when you're actually looking at stock market, it gives you way higher investment return. But anywhere from between those two, bank and stock market, comes the mutual fund, which is a little bit more conservative, and it helps you to balance your risk. So if you're afraid of losing too much money, you're safer to put this in here and actually observe how much it's growing. So 7%. So here you're looking at $100 every month for the next 25 years. You can see your TFSA would give you $78,000 in here. So if you have a little bit more money, you can see, let's say we want to put in $500, and then you can see the amount of TFSA now is $393,000. So that's how much your money can grow. So you might not realize it. It's a small amount that you put in sometimes. Now 500 is large, but you can start with $50 or $100. Any little amount helps, and then you can just leave it there for whenever you need that money, and then you can withdraw it. So the money would actually grow at this percentage of interest and give you a accumulated total at the end, and you can actually utilize this money in the future. And that's called TFSA. So it's savings that you can use. All right, so now I'm just going to ask you if you have more time. There is a little video clip in here where you can actually go in and watch how to actually prepare a budget. It actually walks you through. It's a 4 minute or 5 minute video. You can actually take down this website and just take a look at it and see if you can. And there's another one, a YouTube video on creating a budget as well in here. So you can just jot those down and see if you can watch those videos and see how that goes. All right, so I'm going to open the floor to questions and answers. If you have any questions, you're most welcome to ask me. And so certainly I can help you with that.
Hi, I have a question.
Yes.
Well, first again, thank you. I really enjoyed this presentation. But one of my questions is about TFA, TFA, and it is about, so you talk about it doesn't matter how much the amount, as long as it keep growing. Is it one of the best way for students?
I would
for
say
saving?
yes. I would say for students, yes. It's best for lower income earners. As I said, you would start off with a budget. So you have to basically find a way to put money aside. That's the key. So in order to put money aside, you have to live within your means and make sure that you have the extra cushion of money where you would not come into a negative flow or negative amount where you're saying, oh my goodness, I don't have enough money to pay for something, instead of actually living within the means and saying, oh, I have extra. So that extra money where you save is what you would actually contribute towards your TFSA account. So you don't necessarily have to maximize these amounts if you can't. But if you have the room to maximize, I say do it. So for anyone who is making less money, especially when they're starting off their career and they have so much of debts and expenses, I would say start off with TFSA. It's definitely designed for lower income Canadians, to help them to save more money. And it doesn't penalize you from actually taking out the money whenever you need to or want to, because it's tax-free.
And where could we find that budget link?
So that
did you put it in into the chat?
Oh, okay. If I can.
Yeah, so we could kind of look, so I could look at the videos at a later time.
Sure. I can actually link this budget. This is a very good one here. So let me see if I can copy that.
And there's also a question in the chat box after.
Okay, so if I can open this up here. Okay, so I'm just gonna put in the link first. This is how to create a budget. Hopefully that came through.
So,
that coming through?
Yeah. No, but do you want me to,
No?
could you see the questions or you want me to ask it? Read it out fair.
I can see the chat, but did you get the link right now? I just posted.
No, I haven't seen it.
Oh no. Oh dear.
But you know, when you send your document to us,
yes.
if you could send that link, we will really appreciate it.
Okay, yeah, it's in the document, but it looks like it's not going through. I'm not sure what it is. Okay. So I see from Yuan, why might you put your money on a savings account over a TFSA? I personally have both, but I've been thinking maybe I should put as much as possible in the TFSA rather than in my savings account. Yes, I agree. So you want to put your money towards TFSA because TFSA is an investment account where the money can grow in a larger percentile. Now, savings account, a bank that provides you at a very low interest. So it's basically they take your money and they utilize your money and invest in a larger pool, but they give you a 2% in return. So your money is actually earning a very small return. It is very conservative, so there is absolutely no risk. So it's very safe, but it's a steady growth. It's a very slow growth. But a TFSA, when you put it into an investment, you have a little bit more, as I showed you in one of the TFSA calculation, I just put in 7%, and usually anywhere a mutual fund will give you a 7% growth, which is actually not too low, not too high. It's quite conservative in some nature, but it balances the risk. So you get a little bit more of a return. And you can also go in and actually change things around. So if you feel that's too risky in an investment, you can actually move that fund. You can actually talk to your broker and say, I don't feel, I feel risk. It's too much of a risk. I don't want to take that risk. I feel scared. Can you move that to a lower conservative investment? And they can do that. So that would be my answer. So I would definitely put it towards TFSA. So what you're doing is actually great. And you can actually monitor that if you have an understanding of how money actually grows and so forth. Is TFSA, if TFSA has a limit? Yes, it does. So as I shared this screen here, I'm not sure if you can see this, slide 9. So every year there is a limit that's been actually released by the government. So it all depends on how much your limit is. As I was saying, you have to be 18 years and over. You have to be a Canadian citizen. You should have filed a tax return using your SIN number. So if you've done all that, and let's say you turned 18 in 2009, you have maximum of all these amount added together is your limit, basically. That's 75,500. So if you've never invested and you already turned 18 in 2009, that means you have 75,500 to actually contribute towards the TFSA investment. But if you turn 18 after 2009, you would actually find out which year that you turned 2009, and then you would calculate from that year to today and add all that total number and actually find out how much. So here, this is what I was saying. 2009, if you actually were 18 at this time frame, doesn't matter when you turn 18 and which month I mean, but as long as you turn 18 in 2009, you can actually take a calculator and just keep adding each maximum amount up to today, 2021. And that would actually tally up to 75,500. That would be your maximum limit for that question on the chat. So if you turn 18 somewhere after 2009, let's say 2011, so that means from this time onwards, you can actually add every number up to 2011. So that 5,000 plus another 5,000 plus 5.5 and so forth would be your maximum limit, leaving out the 10,000. So 75,500 minus 10,000 will give you 65,500 maximum contribution limit if you turn 18 in 2011. And that's how it works. So it all depends on when you turn 18 and if you are a Canadian citizen at that time frame when you turn 18, and you would have actually had to file a tax return based on your regular income. Somebody's asking me, what is PR? What does it stand for, PR? Permanent residence. Okay, that's a good question, actually. So if you're a permanent resident, so if you have actually a SIN number, permanent residency, yes. If you have a SIN number, SIN number, and you have been living in this country, and you have the definition of Canadian citizenship, then you can actually you should be able to take advantage of this TFSA. Now, let's say if you're a Canadian citizen and then you actually decide to leave this country, then you'll lose that contribution, and then you might be penalized 1% on the whole balance if you contribute thereafter. So anything that you contributed up to that point stays, but anything that you contribute after you become a non-resident would be actually penalized at a 1% rate on the total contribution thereafter. So you need to look out for that. That's actually an excellent question for a non-residency or non-Canadians. As long as you filed your tax return and you have a SIN number and you're 18, I think you can contribute towards that. Okay, so you were saying budget. Actually, I have some time. Why don't I play this video for you? Shall I do that, Carol? So that way the students can actually get it.
Yes.
Okay, so let's do that.
Thank you.
Creating a budget. This video will discuss the 7 steps to creating a budget. 50-20-30 rule. It doesn't matter how much money you have. One of the most important things you can do to manage your money is to budget. If wrapping your arms around such a mighty task seems difficult, don't worry. This video will provide you with step-by-step instructions on how to budget and ideas to make the act of budgeting part of your routine. Step 1, track your income and expenses. It's time to do a little journal. Not the Dear Diary type, but the kind that deals with numbers. Tracking your income and expenses is best achieved with a money journal. A money journal can be a notebook and pen, a spreadsheet, or any on or offline tool that works for you. Every time you receive money, note that as income. Every time you spend, note that as an expense. Voila, step 1 is done. Step 2, set your income baseline. You need to answer the question, how much can we afford to spend? Let's find your income. The most common form would be from employment, but others could include money you've saved for college, family contributions, scholarships, grants, or gifts. Student loans can be considered a form of income, but they should be used sparingly and only for essential education-related expenses. No credit product, like credit cards, can be considered a form of income. Jot down all your income sources, add them up, and this is your income total, also known as your baseline. Step 3, determine your expenses. Figuring out your monthly and annual expenses will be achieved in 3 ways. The first way is by looking back. Grab your last 3 months of checking your credit card statements and see where you spent your money. The second way is by looking forward. Budget for your fixed expenses. For example, a 12-month lease with payments of $400 a month is fixed for the next year. Other fixed expenses could include internet dues, car payments, and childcare. Variable or unexpected expenses include things like groceries and utility bills. The third way to determine your expenses is achieved with your money journal. You'll see after a few months of tracking where your money is going. Use that data to analyze your spending. Step 4, categorize your income and expenses. This step is entirely up to how detailed you want to manage your budget. If you want to budget for groceries, you can simply create an expense category for the food you purchase from grocery markets. Or if you want more detail to your budget, you can track how much you spend on milk, meat, vegetables, desserts, and so on. Be as detailed as you like. At minimum, we suggest breaking your income into categories of employment, family contribution, and student loans. And your expenses, at minimum, should include categories of housing, food, transportation, education, and non-essential expenses. However, if you have other large budget items, be sure to make categories for those as well. Step 5. Compare your income to your expenses. You may have learned that you should balance your budget, which means your income and expenses should be equal. In reality, you should strive to have more income than expenses. Obviously, having more expenses than income is an unsustainable lifestyle. Think of ways to cut your expenses. Step 6. Make plans for unplanned expenses with a cushion. Building your savings is vital to keeping you financially afloat. If you have a car, you probably budget for maintenance and gas, but you might not budget for a surprise expense like a new alternator. That is where your rainy day fund comes in and saves the day. Your rainy day fund is an emergency fund for unexpected expenses. Without these savings, you may have to use a credit card, and that can turn into a more costly expense if you cannot pay it off right away. Step 7. Turn your budget into a document of freedom. Many people mistakenly think their budget is going to limit their ability to spend and enjoy life. Not so. If you know that buying a new clothing item, seeing the newest movies, or getting a $5 specialty coffee really makes you happy, then make them guilt-free special occasions that fit within your budget. Now that we have the 7 steps defined, consider following the 50-20-30 rule when budgeting. 50% of your income goes to essential expenses like housing, transportation, and groceries. 20% of your income is focused on building your savings and paying off high-interest debt. 30% is for lifestyle choices, things like cell phone, entertainment, and going out to eat. Now you've got the outline of a budget. Start filling in the numbers, and you'll be on your way to creating a budget.
Any questions on the budget?
Yes. It talk about these 7 steps, right? But the first one is to sit down and write everything. But that means you have to write like every living thing that you spend, because sometimes it's a lot, like details is in the spending.
Yeah, no, I would say no, you don't have to. It all depends on an individual. So it all depends on the goal. So basically, I always say prepare your budget based on your goals. So everybody's goals are not the same. So if you have a goal to pay off your debt, that would be actually a column. If you actually are choosing to break your expense into dining in and dining out, and you want to actually see how much money am I actually spending eating out versus eating in, then you probably want to create 2 columns. One is entertainment and one is eating in. So those are the most important columns that you want to create. But as the video said, like if you want to really know where actually my money is going, and if you are a dietitian and you want to actually understand your diet and where your money is going and what am I actually consuming, and then you want to probably break it down. And it's not necessary, but it depends on an individual basis where actually the goal is actually would reflect the ultimate budget, income and expenses. So no, you don't have to actually create every column, but you can certainly create one column that actually captures most of the expenses that falls under that.
Thank you for that. And the next question that I had, let me wait and see if anybody have any questions before I ask.
I'm going through that as well, so I'm not so sure. That is a good point for a contribution. So I think someone asked, what is a good starting point for a contribution for a student? Is $50 per month good? I would say whatever money you have is good. So even if you have $25, you want to put it aside. And the moment you have $25, you want to put it aside, do it. It's actually good to put any amount that you can save, put it aside, especially when you have no control of your expenses. It's very good to put it aside. Or if you feel that amount is small, you can open up a savings account and automatically transfer every week or every month a certain amount, like $50 or $25 out of your regular spending account or where your money is coming in from your paycheck. And then just automatically there's actually it's been allocated out of your regular account to a savings account. Now that savings account, you can actually deposit that and transfer it to TFSA account as well. The sooner you deposit into TFSA account, the sooner money grows. That's the underlying factor in finance. Today, a dollar in my hand is much more valuable than tomorrow. So if I have $25 or $50, I want to put it as soon as possible so it grows and gives me the return that I like to see, instead of actually holding it in a place where it does not grow. So the answer would be any amount that you can actually save. As I said, put it into a savings account and then transfer it out to a TFSA account. Do I have to worry if the interest will go beyond the annual contribution limit? No, you don't have to worry about that. So one of my advantages and disadvantages, if you can see my slide here, would be, it says all earnings on TFSA, such as interest income, dividend, capital gains, are not taxable. So as I said, if you have $10,000 and let's say it grew into 21,000, so it's doubled in your growth, and so now you're looking at what you contributed was 10, but now the growth is 11,000. Would I have to worry about it? No. So the growth can be exponential amount, and you don't have to worry about it. That has nothing to do with your contribution limit. So your contribution limit is physically how much money you put in. The growth is not impacted by your contribution limit or to your contribution limit, and neither does it get taxed. So hope that got answered.
It says here, is there a time period for a TSFA, like 5 years or 10 years? So would it age out? Would a TFA account age out?
No.
Okay.
So going back to the slide again. So let me just,
your slide fonts is really small.
Sorry, say that again.
Your slide fonts is small. Okay, this is better.
Okay, so basically going back to this chart here, oops. So if you actually take a look at it, there is no time frame. So if you have never contributed, let's say, so, and you were 18 in 2009, think about it. You're now in 2021. All these years have elapsed. So it's beyond 5 years. So you can actually go back and input all these amount in your calculation of contribution limit. So the answer is no. There's no time frame. There's no time limit. And there's no such thing as catching up or something like that. But you have an opportunity to maximize and utilize how much money you can put in. So if you have never put in since 2009 and you are today in 2021, you have 75,500 room that you can put in, but it never expires. If that's what you're asking me, not sure if that's what the question is, but it doesn't elapse or doesn't expire. You can always contribute. As I said, if I forgot to contribute last year, let's say in 2020, it's a $6,000. I can actually contribute that the following year in 2021, January, that 6,000 of last year, plus the contribution amount of this year. So I can utilize it, but if I don't have the money, I can always put it in later. So as I said, you can go into my CRA account. If you have never logged in, it's time to create username and password and check your filings of your tax returns, how much retirement money you may get depending on your earnings in the future, and like information like a TFSA room or contribution limit and RRSP as well. So those are good information that you can check. So that's actually independently calculated by CRA, and that information is just customized calculation for you and for yourself. So you can log into that account and check it out.
Oh,
I hope
I didn't know that.
Question.
So anybody can make a TRS, anybody can make a tax account to find out what is the trajectory in your pension. I didn't know that.
Oh, you mean my CRA account? Well,
Yeah.
my CRA account is basically for any Canadian citizen who has filed their tax return, basically, who has a SIN number and who has actually regularly filed their tax return on an annual basis. So at the end of the year, you know how we get the T4? For most of us, it's a regular salary, which is a T4. Or if you have part-time job or you're doing freelance job, you might get a T4A. Whatever it may be, you might have to actually declare that income to the government. So that's when you prepare the tax return. We call it personal tax return. Once you do that, when you file it, you have access to now online. It's been there for ages. So you can actually go into my CRA account and you can just type in CRA.com and then you can just go in there and go into my account. And if you have a username and password, you would put in your username and password and you can actually go in and explore many details about your personal investment and the room for TFSA and so forth. And if you haven't, it's time to go in and create one and keep that password carefully written down because you cannot lose it. And it's very hard to log back in because it's now with the government. So they're very strict securities. So yes, anyone can create a My CRA account. When I say anyone, it's for those who have actually filed a tax return with the government of Canada.
So could international students also apply? Could they have that? Because if they apply, I don't know. I'm just asking a question.
If you're not a Canadian citizen, no.
Okay, so it had to be only Canadian citizen.
Well, you have to, yeah, because then you would declare the income that you earned here. But if you're a permanent resident, then you're definitely earning money, then you would actually have to declare your money that's earned here. So, I mean, even if you're not a citizen, the rule of thumb is, without getting into the detail of it, you have to declare your income. By law, you have to declare your income. But if you're a dual citizen, and so if you're actually declaring in another country like USA, then you have to actually let CRA know that you are declaring and paying taxes in another country, so you get exempt, so you don't pay taxes in both countries. But definitely, if you're earning money in their own country, you have to declare that income to the government by law.
Wow. I don't know.
Even cash money, some people think they shouldn't be declaring it, but any income earned should be declared. And that's when you can establish yourself also in the country, build your credit rating. So even just to get a credit card these days, you have to have a credit history, right? So if you don't have a proper income that you don't register and you earn and you don't pay taxes, there's no information about you to actually double check and see, okay, has this person paid the...
What was your last point? Sorry.
Oh, I was saying anytime you're making money, it is best to have a record of anything so you can establish yourself in this country and build yourself up, be it a foreign student or a non-foreign or a local resident. It's always good to establish yourself with having to pay taxes and registering yourself and actually declaring your income, so you have something there that people can check your credit history and your lifestyle and actually reward you accordingly. So if you have no credit history, banks would be hesitant to provide you with a credit card, for example. So how do you actually go about, purchasing anything and building your credit history? And it's very difficult. So what I was saying is, it's good to declare your income, be it cash or non-cash, and it's good to pay taxes to the government because you're contributing to the country, of course, for the general purpose of consumption. But at the same time, you're actually building yourself up and having a credit history as well with the bank, the institution, and so forth. So it's good to have all that registered, so you are actually having an established history there for yourself. So the earlier you start, the better it is. Opening up a bank account, the longer you have a bank account, and then you're spending and utilizing your money in and out, the bank gets to study you and then know that you're actually a person that we can trust in the future. If you want a loan, they would actually study your history and say, okay, I think we can trust this person and give X number of dollars based on the history alone, if you ever needed one, and so forth. So that's what I was saying.
I know that that we are wrapping up here. So my final question is what will be if anybody had to take away anything from this presentation, what is the advice that we could start to work on right away, like action that we could take away?
Yeah, it's a very good question. So if you have, if you are still a student and still working away and going to study further, or you've completed your study, either way, I would say start off with a budget. And you heard the 7 steps of budget. And the simplest way is to basically go in and plan, set goals, make sure they're realistic goals, and then actually say, this is my goal. So write it down and then put a timeline, put a straight line, put like year 1, year 2, 2021, 22, and so forth. So plan and then see when you see yourself paying off your debt or planning to actually live within less money. As you heard on the video, cut cost as much as you can. So the video was giving you 50, 30, 20 rule. So you will live in the 50% of your main expenses that you cannot get away with. Those are called essential expenses. And so that means 50% of your money that you earn is going towards your essential expenses. But it says save 20% of your earnings. So for every dollar, you're putting away 20 cents. For every $10, you're putting away $2. For every $100, you're putting away $20. So you're putting aside 20% of your earnings. And then the rest of the 30, it says it's actually a lifestyle choice. So if I choose actually not to eat out, guess what? I'm actually saving more. So your 20% saving is actually going up now just by cutting your costs. So first, I would say set a goal. Like I've outlined here, it depends on an individual, what you want to do for the next 1 year, 2 years, 3 years, or even 10 years. Where do you see yourself in terms of managing your money? And then actually work towards it, prepare a budget, and then start jotting down where your money is going right now, where are you spending. You get to actually learn more about yourself. So that's the takeaway here is start with a budget. And then eventually when you get into a good habit of keeping up a great budget, then you will actually learn where to cut and where not to cut. Do I want this or do I need this? That's the ultimate question for all of us. So once you decide and you're able to cut the cost, then you will be able to succeed in putting money aside. So until then, you won't really know how much money to put in, because sometimes in certain months, believe me or not, you might be able to save a lot more than the standard amount. So it's always good to understand where your money is. So I would say that would be my takeaway or giveaway today for you, is to start off setting goals, multiple goals, and then monitoring where your money is, and then planning for the future. Now that I know these are my regular expenses, these are the what if, if anything happens, these are the costs that it may happen or it may take place. And then these are the extra expenses that I may spend. And then plan for the future and say, okay, I know what are my regular expenses, and I know I can cut this, I cannot live without this, and so forth. And so start off with that, and then it will take you to putting money aside. Once you put your money aside, you're ready to open up a savings account and start saving.
This is the end of it, but I really appreciate all what you offer. Thank you, Gopika. Thank you so much. This is really good takeaway.
Great. I'm glad, and I hope it was useful for all the students as well.
Oh, absolutely. Okay. And we will post what you have here on our website, so students could come back and look at it.
Sure, definitely. I mean, are you able to pull down my share screen, or should I email it to you on a separate?
I think you had to email it to us separate
I
so we
think there
could
was a
upload.
question initially, I think from one student said, can we have, will the slide deck be shared to us after the presentation? So it's something that I created, so it's okay to share. So I can definitely email you the copy of it and you can upload it to their website or wherever you need to.
Thank you.
Okay, you're welcome.